Can you see the screen, the presentation in full screen mode? If you could just give me a quick yes or no, that'd be great.
Yes.
Okay, wonderful. Thank you very much. So first of all,
fine.
thank you very much for having me. It's an absolute pleasure to present my research to everyone. Before I jump in, just a quick heads up. This research that I'm presenting today is not finalized yet, in the sense that it hasn't been published. It is something that I'm currently working on to publish in the future. So I'm very much looking forward to hearing your feedback and your thoughts at the end of the Q&A session. The way I'm planning this is to talk for about 20-25 minutes, depending on how it goes, and then switch over to the Q&A to also get your feedback. But let me first introduce myself. My name is Robert Richter. I am a PhD candidate at the Technical University of Munich. Now, my background is slightly more varied, I'd say. So I've got a background in economics with a focus on econometrics from the University of Warwick. And after my master's degree, I decided to go into industry, actually. So, well, banking. So I worked in a bank for 1.5 years, then switched over into consulting, and have, well, got stuck there ever since. I've been working in banking / consulting for the past 10 years with a focus on credit risk modeling, actually. And I'm now a senior manager at Zanders. Zanders is a consultancy focusing purely on quantitative aspects of risk finance and treasury. But at the beginning of, well, in 2018, 2019, I wanted to go back into academia and wanted to find a topic that really interests me and that also made sense with my career path, mostly being finance. And I came across blockchain technology. So I started reading up on the topic. And in early 2020, I then decided to become a research fellow at the Frankfurt School Blockchain Center, headed by Professor Philipp Sandner. And I spent 2.5 years there focusing on the applications of blockchain. And given my background, mostly analyzing decentralized finance protocols, but of course also working alongside on various projects, for example, Blockpool, which was EU funded. For the past 6 months or so, I transitioned into the Technical University of Munich to then move on from being a research fellow into becoming a PhD candidate. However, at the same time, I still give lectures at the Frankfurt School of Finance with a specific focus on blockchain technology. Now, I quickly want to also introduce the rest of the chair of the Technical University of Munich, because I'm not sure everyone can be here today, but I'm actually part of the chair of strategy and organizations, headed by Professor Dr. Isabel Werpel. And that chair is split up into 2 different streams, if you will. So one of them is focusing on blockchain technology. The other one is more focusing on the area of startup success. And the people you see here are the team in the blockchain space. So Eva Meyer and Benedikt Eickmanns are very much focused on decentralized finance together with me. Pascal Mehrwald is about to finish his PhD, and Christian Ziegler is very much into decentralized autonomous organizations, or DAOs. But what I want to discuss with you today is not actually the chair or lots and lots of my background, but I want to talk about valuing digital assets. And during the presentation, I'm going to use digital assets, crypto assets, and maybe sometimes even cryptocurrencies interchangeably. I will try to stick to digital assets because I don't want to open the can of worms whether it's a currency or not. But I want to focus, or my research is focused on identifying actual value drivers in different decentralized finance protocols. So relatively focused in the sense that I'm only looking at DeFi. I'm not looking at the entire blockchain universe because A, that would be too big, and secondly, my area of expertise is the finance sector, so I'm very much focused on that. And whenever you talk about the topic of modeling digital assets, predicting prices, there's unfortunately really only 2 topics that pop up. And I'm sure that you've seen most of them. One of them is Bitcoin and stock to flow. So for the people that haven't heard of the stock to flow model, it comes from the gold industry. And essentially it models how many years it would take to dig up the same amount of gold as we have now in stock. And usually it's a number expressed in years. And given this whole discussion whether Bitcoin is digital gold or not, that model was applied to Bitcoin. And historically, it performed quite well. With the most recent price drops, as you can see here, the model is not performing as well. And there's much more fundamental debate that really kicks in here. And the question really becomes, is Bitcoin digital gold? Can we compare that in terms of fundamentals, in terms of market behavior, or not? Very few people talk about other topics other than Bitcoin, because Bitcoin is the big one. The stock to flow model has been applied and the discussion has been around for quite some time. Whether you agree with it or not is an entirely different matter. I know I have my opinion, happy to discuss that in the Q&A later, but you find very little regarding valuing other cryptocurrencies, for example, Solana, Ethereum, Cardano, etc. The other thing that you find relatively frequently is discussions about modeling the volatility of Bitcoin, so or cryptocurrencies in general. Now, we all know there are very, very volatile assets, which means there's a lot of money to be made if you buy at the right moment and can predict volatilities. So that's an area that has also received quite a lot of attention. But whenever I read through these articles, there was one thing missing for me, and that was a really structured framework as to what theoretical price drivers even should be. To give you an example, I mean, yes, Bitcoin, stock to flow maybe, but what about other cryptocurrencies? How does a platform differ to a lending and borrowing protocol? And what I found there is that there was no real framework tying everything back to one another. And that's really where my research kicks in. Now, of course, there are some valuation methods, some being used from the old world and some being newly developed. Given the fact that we're looking at financial institutions, I first thought about it in terms of valuing a bank. Now, when I did my chartered financial analyst exam, or the 3 exams, there was a whole framework set up on how to value certain companies. Now, if we take, for example, banks, as you can see here, I've tried to represent this with a little house that shows the different use cases that banks fulfill. You have current accounts, banks essentially being a custodian. Of course, they do lending and borrowing on your behalf. That's one of the key aspects of, or one of the key fundamentals of banking. And then they do other things like asset management in certain areas. They are market makers and many, many more. So I'm not saying that banks are limited to these use cases. I just wanted to give an example that a bank as we know it encompasses a whole bunch of different use cases. Now, in those banks, there we have a relatively established, or a very established process on how to value them. They have all of the balance sheets, and there's a myriad of different ratios, for example, that can be used. Price to earnings ratio, for example, or price to book value. There's even other ratios like price to deposits or price to revenues, which weren't found to be as good predictors. But in general, we do have an established framework. And now the first question I asked myself was, is that a framework that we can actually apply to crypto? And there was the first thing that I struggled with was the view of this house. So when you look into crypto, of course, there are all these use cases that a bank does are also essentially I don't want to say taken over, but can also be fulfilled by a protocol or a decentralized autonomous organization, for example. So we do have custodians. We do have lending and borrowing use cases like Aave. We do have asset management like token sets, or we have market makers and liquidity providers like Uniswap. So we have all that. But the main thing that I found different to banks is that those are individual protocols, right? Banks have been known to build things themselves, have their own applications, and then go out to the market and offer those products. Now, in the decentralized finance world, that's no longer the case. So the way I see this is this house ultimately breaks down in the decentralized finance world. And please don't take this the wrong way. I'm not saying that banks are obsolete or anything. I'm just trying to visualize the differences here between our current traditional financial system and the decentralized finance world. Now, going back to the valuation part, those banks and the valuation processes are company-centric, right? You look at the audited balance sheets, and that balance sheet is based on all those different use cases: lending, borrowing, custody, asset management, etc., etc. But given the fact that this house essentially breaks down in the DeFi world and all those protocols stand by themselves, and the user can then choose whether they go with Aave or Compound, for example, means that there is no holistic viewing. So in my view, the valuation process even needs to shift from a more from a company-centric view into a protocol, or more specifically use case perspective. So a use case-centric valuation, and that's essentially where my idea kicks in. Now, before we go into the details on my framework, I also wanted to discuss some other valuation methods, because there are some methods that have been used in the past to attempt to value decentralized protocols. One of them is Metcalfe's law. So this is a law that originated in telecommunications, and it's essentially based on the assumption that the more users we have and the more users are actively using a network, the more valuable it becomes. So if you have a look at the graphic on the right-hand side, if we just have two telephones connected, those two users, I'm sure, have great value, but overall, from a company perspective, it's pretty small, and it essentially boils down to a low value of the company. Now, of course, the more users connect to the network, the higher the value. So in the second example here, we have 5 connected telephones, which can all interact, which means there's a lot more potential use, and therefore a higher value for the protocol itself. But what this theory is really saying is that the more users we have, the higher the value of the network. So in this example, the network shown at the bottom here with many phones all being interconnected, that would be the optimal choice, essentially, out of all 3, because we have a lot of users connected, and therefore we have generated a lot of value. But of course, there is an argument around diminishing returns of this theory. Quite like to put a pin in that, because I don't think in decentralized finance we've reached a size where we have diminishing returns on size yet. But again, when reading this, the question really becomes: is that applicable to every protocol? So in decentralized finance, again, we have lending, borrowing, we have payment tokens, we have liquidity pools. Is that a good way, just as a catch-all or like a blanket approach, to investigate the real fundamental drivers? I mean, of course, the more people use the network, the more valuable it is. But what's driving people to use that network? So why are people using Aave instead of Compound? That's something that this methodology doesn't explain. It just looks at how many people are using it and then therefore what is the value of it. What it doesn't address is why are people using it in the first place? What makes that protocol more attractive than the others? Again, that's something that I want to look into. But over time, there were also some other methods and ratios invented. For example, the price to new addresses ratio, because essentially there was an analysis run to find out how the how new addresses becoming live in the protocol impact the price. And what was found is that it accounts for 8% of the volatility in price returns. The more interesting fact from my perspective is when looking at future price movements, it was actually found to be a negative predictor. So here again, the question for me arises, is this a useful predictor? And can it be used for everything that we have in the ecosystem? And specifically, all those different types of DeFi assets. Personally, I'm not convinced yet, because it all ties. This sort of ties back to Metcalfe's law, which essentially says the more addresses we have, the more value we're going to generate. But again, why do we have those new addresses linking up to our network? Now, there are some associations that are trying to address this sort of myriad of tokens in a slightly more structured way. I just quickly want to outline this to then also show differences to my approach. There's the so-called ITSA, the International Token Standardization Association, and they essentially focus on three different things. They want to create an international token identification number, like an ISIN for tokens. They look at classification of tokens, and then they have a big token database. For me personally, the classification aspect is of course most interesting. And what they do there is they essentially break down tokens into 6 categories. So the first one is economic purpose. So what's the use case essentially? The issuer industry, the technological setup, legal claim, issuer type, and the regulatory status. Now, when I spoke to someone from the ITSA, they said, hey, you should really use our framework to then drive your research forward. And looking at all of these different categories, again, my question is, are those really the price drivers of cryptocurrencies? So, for example, is the issuer type relevant for the price, or is it mostly the use case or the technological setup? Do we care how many nodes we have in the network? Of course, it needs to be decentral enough.
Robert, do you want to turn your camera off? Your connection is a bit
of course
broken. So maybe if you turn your camera off, it'll be better.
Okay. How is it now? I'm hoping that things are okay and you can hear me okay.
Yeah. You may continue.
Okay, very good. I'll try to speak as enunciated as possible. Now, again, with this framework, what I challenge is all of this relevant for price drivers? I think in terms of categorizing a token, it's a very, very useful setup, because you have a nice overview of legal claims, the setups, etc. But is that really what's driving people to use these protocols? And here again, my challenge is I'm not convinced yet. Bear with me. Yes. So whenever I read these articles, I'm thinking there's something missing. What we do know is that the use cases of different cryptocurrencies are fundamentally different. So if we look at Bitcoin and Ether or the Ethereum protocol, for example, the use cases couldn't be more different. Similarly, if you compare Bitcoin to, let's say, Uniswap, fundamentally different. it's how does that saying go? It's like comparing, saying who's going to win in a fight, a lion or a shark. Well, it obviously depends on whether you're in water or on land. So, point being, the use case is very, very different. And my hypothesis is that given that the theoretical use cases, or the use cases are very different, the price drivers should also be different at some point, especially the more the market matures and the more people understand that Bitcoin is not the same thing as Ether. My hypothesis kicks in here, saying, look at the use case of the actual protocol. And that is something that has received fairly little attention, in my view, specifically looking at a holistic framework of the DeFi ecosystem. Of course, you see some papers specifically about stock to flow or about the price to new addresses ratio, but you see very little holistic and theoretical work in that sense to determine what, from a conceptual point of view, should be driving the price of these DeFi protocols. And that's essentially what I want to do. Let me just skip this slide here because it's all visualized on this one. So the way I'm thinking about this is that decentralized finance can be categorized into a number of different categories. I haven't shown all here just for the sake of simplicity. But for example, you have platforms like Ethereum, Algorand, Solana, Cardano. You have payment tokens. We even include stablecoins in there. You have things like exchanges. You have lending and borrowing platforms. And from my perspective, you need to be very, very specific about what price drivers or what valuation methods you apply here. Because what drives the value of Ethereum or the Ethereum blockchain? What drives the value of Uniswap? From a theoretical perspective and concept, those answers should be different. Because Ethereum is a platform that allows us to build smart contracts and decentralized apps on top of it. Whereas with exchanges, it's, from my perspective, more about the number of liquidity pools, for example, or the services we're offering, transaction volume, and potentially the number of people using it. So that's really what I wanted to highlight here. And I have some thoughts on this that I'd really like to share with you, and then get your view. Looking at the time, let me finish off this slide, and then we can gradually move over into the Q&A session. So, for example, here with lending platforms, I just mentioned it. The main purpose is to give us a platform to then develop additional smart contracts, decentralized apps, or whatever else we can come up with. And from my point of view, that is what should be driving the value of these platforms, because that's their sole purpose. So, looking at Ethereum versus looking at Solana, if you have way more smart contracts and dApps deployed on the Ethereum blockchain, should, in my perspective, from a theoretical point of view, drive those prices. Now, when it comes to payment tokens, specifically if we talk about stablecoins, there I do see an application for Metcalfe's law, because I mean, whether let's be honest, whether we use one stablecoin or another, we can still transact unless we're talking about a Terra Luna situation, for example. But there it might very well be about the usage. It might also very well be about the type of backing that we have, whether we have fiat currency backing or an algorithm backing the stablecoin. Similarly, with exchanges, again, what's driving the fundamental price? So what's making people use that specific exchange rather than another one? And here again, my current thinking is it must have to do with the services that are offered. And in the case of exchanges, that would be, for example, the types of pools that you're offering, the liquidity that you have in those pools, the transaction fees, and that will ultimately make people use that exchange. So again, I think here it's about the use case and the offering of the protocol. Similarly with lending and borrowing. Now it could be something like how many people are defaulting. Do we actually have any credit losses, or is it all absorbed by our collateral? Are we even in an unsecured lending space where we don't have over collateralization as we have in most protocols? Or is it the liquidity of the protocol that really gives people the incentive to start using it? So that's, in a nutshell, the idea of the research, to essentially take the DeFi ecosystem, categorize it, of course, into more than 4 categories, and then look at first of all, the use case, and then use that use case to determine the offering, and analyze the offering, or analyze whether that offering and the quality of the offering has an impact on the price. So the way my research is structured is that this is supposed to be a theoretical paper in the beginning. And then, of course, once the theoretical framework has been set, then that theory needs to be put to a test and actually analyzed from an econometric perspective to see if those theories are, well, proved to be correct or not going forward. So that's a very high-level overview in the 30 minutes that I have for outlining the idea behind my research. So I'm now very happy to stop talking and actually hear some feedback. And by all means, if you have opposing views, let me hear it. Very happy to get your thoughts. How does this work, Tammy? Do I ask people to just speak up, because I see that some people have raised their hands, or do people just go one by one?
Well, there's one in the text box. I think you can answer, and with people who raise their hands, you can yeah, I'll allow them to talk, and then they could ask questions. Okay,
then let me answer the ones from the chat first. So the question is, how would you measure the hype effect in a price of a chain, perhaps marketing budget of platform, Twitter followers, etc.? I guess you can find that information if it is a DAO. So there's, there are some options here. The one that I am thinking of going with is a social media index. So there's a website called Sentiment, for example. They measure the sort of hype in social media of a specific protocol. Or for Bitcoin, for example, for Ethereum, they have these social media indices. So that would be my first my first controlling variable, because it looks exactly into what you mentioned there: Twitter followers, Reddit posts, etc. And I think that would be a starting point to measure the hype. So Tammy, happy for you to allocate people and ask them to raise their questions.
Yeah, Julian, do you want to go next?
Yeah. So hi, Robert. Can you hear me?
Yes.
So my question is like, how much do you think like accounting will be related to your research, since we are building like a valuation method? Like, yeah.
So I think that's going to be a let me say a second step. So I think the first step, or well, the way I see my research is, in the first step, it needs to be a theoretical framework first to assess use case and the offering, essentially, to then find out what the price drivers are. And then in the next step, accounting will become relevant to identify what ratios are relevant. So is it price to new addresses, or is it something entirely different? Is it maybe the price to smart contracts deployed? So I can't completely answer your question yet. Hopefully by the time the second paper comes out, but it certainly will be a relevant factor.
Yeah, okay. I have another question. So, I think right now, like many protocols, they have like various functions. For example, like they are both like DDEX or like lending and borrowing like protocols. Like, how are you going to decide, or like how are you going to resolve this issue? Things like during like your talk, you were mentioning like they are separate functions, but I think right now they have many different functions in like one protocol. Yeah.
Good question. I mean, it basically depends on the categorization. I mean, when we have a protocol that does lending and borrowing and acts as a decentralized exchange as well, that might be something to park and just look at, in quotation marks, pure protocols. So if you look at Compound, for example, come up with a theory there, and then you can test that on these, let's call them mixed protocols. But I think it will be very, very difficult to base the theory initially on mixed protocols and test it econometrically. I think you first have to start with protocols that fulfill one purpose, and then test that theory. And of course, when I say one purpose, it depends on the use case. I mean, we all know that Ethereum ultimately fulfills a whole bunch of purposes. But if you categorize it as a platform, then it's fairly clear in terms of what theoretical price drivers you should be looking at.
Yeah, or I think that's all my questions. Yeah, I think your research is really interesting. Yeah.
Thank you. Glad to hear that.
Thanks. Do Neil want to go next?
Yeah. Hi, Dr. Roberts. Can you hear me?
Yes, I can hear you perfectly.
Yeah. Thank you for this presentation. I had two questions. The first question was regarding central bank digital currency, maybe a wholesale. That is majorly a pilot project in different countries now, and some are already rolling out a CBDC. Just wanted to know what can be the use cases where the DeFi, right, decentralized finance, can go in complementary with the CBDC. That is question number one. Supplementary question is, in terms of decentralized finance, right, how can it actually help growing economies in terms of their gig workers and in terms of financial inclusion? Yeah.
Some very interesting questions. So I have to be upfront. I'm no CBDC expert. There, my former colleague Jonas Groß would certainly be able to answer the CBDC part better. But in terms of use cases, and specifically in DeFi, I mean, one thing that we still have to be aware of is stablecoins aren't really regulated yet, right? After the Terra Luna implosion, of course, it's something that is becoming more and more relevant. But at the moment, we're moving into a space that where stablecoins are not regulated. So we don't have deposit protection per se just because we own a stablecoin. Now, from my own perspective as a financial industry person, the way where I see CBDCs and DeFi really coming together is if the CBDC is issued, banks can actively hold CBDCs and then get more involved in the DeFi ecosystem, because that's one part we are still lacking, right? We see asset managers entering the space, but it's not a fully fledged situation where all banks are completely active in the DeFi world. So I think that's a sort of either the CBDC is missing or the regulation around stablecoins is missing. That we don't see that yet, but that's conjecture, of course. Now, your other question about growing the economy, I think that's a very tricky one because it depends very much on the economies that you're talking about. So personally, I was born in Germany, spent a lot of my time in the UK and Switzerland, and those are all economies where the financial services system is functioning fairly well. And of course, we've had the financial crisis. I don't mean to say that it's perfect, but we have the infrastructure to send money to other people, send money abroad, take out loans. So there, I see DeFi more as an alternative to the economy rather than a key aspect to growing the economy. But in other countries, for example, high inflation countries or countries where the financial infrastructure is missing, there I really do see DeFi as a way of growing the economy, because some people, and let's say somewhere in sub-Saharan Africa, may not have access to a bank, but most people these days have a mobile phone. So for them, it would be very easy to join the DeFi space and actually start becoming economically active. Maybe once we get to that stage, take out unsecured loans in the DeFi space, which otherwise wouldn't have been possible because they didn't have a relationship with a bank. Therefore, they don't have a credit score, and hence couldn't take out a loan in favorable conditions. So that's only my perspective, of course. I'm sure there are people that have other opinions, but I think especially in the financial inclusion part, DeFi can play a central role as a niche product.
Thank you, Doctor. Appreciate your response.
No problem, anytime.
Yeah, thank you everyone for coming, if that's all the questions. And thank you, Robert, for presenting. It's great.
Excellent, thank you. Just if I can throw in one more question into the round, just in case you end up thinking about this, one of the topics I'm very much struggling with is market maturity. So at the moment, everything's driven by Bitcoin mostly, if we're being honest. And Bitcoin is very much driven by the tech industry. So we have a lot of NASDAQ influence into the DeFi world. So there I'm still wondering, first of all, if you have an opinion on how to best control for that, and also if you have a view on what sort of maturity of a protocol we need in order for that analysis to actually yield something. So yeah, if I can leave you with some food for thought, if you have any thoughts on this, please feel free to reach out to me on LinkedIn or via email. I'd be very keen to hear your feedback.
Doctor, can you drop your email?
Yes, let me put this into the chat window here. There you go. It's robert.richter@tum.de.
Yeah. Great. So if that's all, we can end it here. And everyone, if you have any thought, you can feel free to email Robert. And thank you again, Robert, for speaking today. And everyone, if you guys think it's interesting, please come to our next month talk, and we'll be doing this kind of seminar every month. But yeah, thank you.
Thank you very much for having me. Bye.
Yep, bye.